You know, in trading, you sometimes come across a setup that just looks, well, perfect. So perfect, it feels absolutely foolproof. But here's the thing. That feeling, that sense of total certainty, it might just be one of the most dangerous traps you can fall into. So let's just ask it straight up. Is there any such thing as a truly foolproof trading signal? I mean, a signal that just works every single time. The answer to that question really gets to the heart of trading psychology. And of course, risk. All right, first, let's build this scene. We're going to look at what seems like an absolute sure thing. A trade that looks so good on paper, you can almost start counting the money. So what we're looking at here is the British pound versus the US dollar on a 4-hour chart. And as you can see, the momentum is clearly pushing down. It's a classic downtrend, prime territory for anyone looking to follow the trend. So here's how a trader would typically play this. They spot a really clear high point and a really clear low point. And what do? They pull out a fan favorite, the Fibonacci retracement tool. They draw it from that swing high down to the swing low, and they're basically hunting for that perfect spot to jump in and short the pair, betting that the downtrend's going to keep on going. And would you look at that? The price has pulled back, and it's hesitating, stalling out beautifully right at that 50% level. Now, for a lot of technical traders, this is like a giant flashing green light. It's a textbook pullback, and it's holding perfectly at a key level. I mean, seriously, this looks picture perfect. The trend is down, the price is pulled back to a key level, and now it's showing some resistance. So if this chart was sitting on your screen right now, what would you do? Are you jumping in? Are you shorting this thing? And this is where it gets interesting, because this is where the technicals start to fade into the background and human psychology takes over. A setup this clean doesn't just trigger a click of the mouse. It triggers a really powerful emotional response. You can almost hear that internal monologue, can't you? It's this rush of adrenaline and just pure certainty. Suddenly, you're not just seeing a probability on a chart, you feel like you've seen the future. The tool seems infallible. And that, right there, is the beginning of the problem. And just like that, the mind starts to drift. The source material puts it pretty humorously. You start daydreaming about that brand new Maserati, maybe with a movie star riding shotgun. You're not just planning a trade anymore, you're already spending the profits you haven't even made. And this is the real trap. This daydream, this feeling of absolute certainty, it's incredibly dangerous. Why? Because in all the excitement, it's so easy to forget the single most important part of trading, managing your risk. Maybe you forget to set a stop loss. Or, worse, you risk way too much money on this supposed sure thing. So what happens when this feeling of absolute certainty crashes head-on into the cold, hard reality of the market? Let's see how this actually plays out. Okay, so our trader, just filled with confidence, they go ahead and place their short order. They're sitting back, waiting for the price to drop, and, fund that new car. But the market? Well, the market had other plans. And bam, there it is. A complete and utter failure. The price doesn't just nudge past that 50% level. No, it explodes upwards. It just rips through every single Fibonacci level and rallies all the way past the original high point. The perfect setup? Yeah, not so perfect after all. And this slide really just says it all, doesn't it? On the left, you've got the dream, that clean, predictable, beautiful setup. And on the right, you've got the painful reality. Because at the end of the day, the market is unpredictable, and it owes you absolutely nothing, no matter how perfect your chart looks. So, poof, that Maserati fantasy is gone in an instant. But what's worse is that if that trader got swept up in the moment and didn't manage their risk, if they didn't have a stop loss or they bet the farm, their trading account just took a devastating hit. This right here is how accounts get blown up. So after the smoke clears from that disaster, we're left with the most important part of this whole thing, the lesson. What can we actually learn from this? Let's really break this down. Is the lesson that the Fibonacci tool is totally useless, or that technical analysis just doesn't work? No, not at all. The real lesson here is actually much more subtle and a whole lot more valuable. Here it is. This is probably the single most important takeaway. Technical tools do not predict the future. They are not prophecies. They simply help us identify scenarios where the probability of something happening is higher than normal. They are tools for managing probability, not crystal balls. They can and they absolutely will fail sometimes. The source material actually highlights 3 key pitfalls to remember. First, the market can just completely ignore these levels. I love the analogy it uses, blowing past them like LeBron James bullies his way through the lane, just unstoppable. Second, what looks like a simple pullback can actually be the start of a full-blown trend reversal. And finally, and this one's huge, choosing the correct high and low points is totally subjective. 2 traders can look at the exact same chart and come up with completely different levels. Now, this might seem like a really strange quote to show right after we just watched a pattern fail so spectacularly. But this quote from the legendary trader Linda Roschke, it really gets to the heart of the matter. It kind of reframes this whole conversation. So this is the final thought I want to leave you with. The takeaway isn't that you should just abandon patterns because they can fail. No. The real lesson is that mastery isn't about finding a foolproof tool that never fails. It's about knowing your chosen tool so deeply, its strengths, its weaknesses, and especially its failure points, that you can manage your risk no matter what the market decides to do.